I don't think I've talked that much about tech companies, but the truth is I was too dumb to realize what was going to happen. Even though I admired Jeff, I've admired him for a long, long time and watched what he was doing, but I did not think that he could succeed on the scale he has. I didn't even think about the possibility of doing anything with Amazon Web Services or the cloud. So if you'd asked me the chances that while he was building up the retail operation, he would also be doing something that was disrupting the tech industry, that would have been a very, very long shot for me. I've really underestimated the brilliance of the execution. I mean, it's one thing to dream about doing this stuff online, but it takes a lot of ability. It always looked expensive, and I really never thought that he would be where he is today. I thought he was really brilliant, but I did not think he would be where he is today when I looked at it 3, 5, 8, 12 years ago, whenever it may have been. Charlie, how did you miss it?
It was easy. It was done there. It was very difficult. It was not at all obvious that it was all going to work as well as it did. I feel any regret about missing out on the achievements of Amazon. But other things were easier, and I think we screwed up a little. Well, I meant Google.
Well, we missed a lot of things.
That's our secret. We don't miss them all.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Why is Warren Buffett value investing into Snowflake stock? Is it the time to buy Snow stock? Even though Warren Buffett's investing performance has declined in recent years, with Berkshire Hathaway's near $1 trillion size, heavyweight in the market, and the surge of AI stocks like Nvidia, Palantir, and Bitcoin dazzling investors. The Oracle of Omaha is still the iconic role model that many investors aspire to be. When Warren Buffett speaks, the markets react. The whole world stops to listen. This is the reason why oil prices are so high, because Buffett owns a lot of oil stocks. Warren Buffett is most known for his value investing strategy, the core concept being a heavy focus on a company's fundamentals, picking businesses with a strong moat or competitive advantage, profitable with straightforward cash flows or growth horizons, long-term intrinsic value, and stable, intuitive products. Berkshire Hathaway's portfolio is filled to the brim with companies that match this strategy, such as Apple, American Express, Visa and MasterCard, Coca-Cola, Kraft Heinz, Chevron, and Oxy. All of these companies have products you can easily understand and would easily sell no matter how much the world resets. Consumers need their iPhones and credit cards. They need their drinks, they need their snacks, and they need their gasoline to power their car's engine. Buffett's focus on value investing that he understands and consequent aversion to investing in software companies or newer technology like AI companies has led Berkshire Hathaway to serious misses in recent years. Warren Buffett hasn't invested in a tech IPO in over 50 years. Not only IPOs, he has been avoiding tech companies like Google and Facebook and dismissing a lot of recent tech IPOs as ridiculous. So when Buffett invested over $700 million into surging tech cloud data company called Snowflake in 2020, it caught a lot of people, including Wall Street, by surprise. Snowflake, since then, has become one of Buffett's most interesting investments, with a paper value of over $1.2 billion on a $735 million investment. Well, Snow stock has dramatically chilled over the past month after the CEO changed. In Jensen's words, Snowflake is a company that stores the world's digital warehouse in the cloud and serves more than 3 billion queries a day for 10,000 enterprise customers. Snowflake is working with NVIDIA AI Foundry to build copilots with NVIDIA, NeMo, and NIMS. Snowflake has remained the only single Berkshire Hathaway's unprofitable cloud-based, high growth software big data company. So what is Snowflake, and what exactly does this unprofitable software company do that has successfully convinced Buffett to go against his lifelong investing philosophy? Should we follow him and own Snow stock? Let me know what you think in the comment section below. Over the past decades, with Oracle, IBM to Dell building big boxes, that market is fairly mature and established when it comes to collecting and storing data. Snowflake's main thesis as a company is that now that companies have collected and stored those data, there is no good solution for companies to analyze those data to reveal the insights about their customers and their overall business performance. There are two types of databases, transactional and analytical. Transactional databases are everywhere on the internet. It's what companies use to store our user information, email, preferences, profiles. Every time I sign up for a new website, I'm added as a row to their database. Every time I update my email, that's an update to my row in the database. When you're on a website with many users, you can quickly see at scale there are anywhere from hundreds to millions of these data transactions that can happen in the database every second. Businesses quickly recognized that all this data they had been collecting would be valuable and monetizable. Some companies have based their entire livelihood around selling data. While most companies never hit the scale of Facebook and Google, where there's so much user data that it can be worth selling. The average business can leverage their existing data to unearth some really useful insights that they can use to optimize their products. The challenge becomes naturally more complex the more a business scales. With more channels a business operates, for example, The Honest Company, she has omni-channel like retail sales in Target, Walmart. She also sells through Amazon and her own website. You can see how those are at least three very different swimming pools of data that can give insights into your products, customer behavior, and business. But to unlock those insights, you have to take these different pools of data that are always growing, put them together into one lake of data, and then run your own analysis once all that data is combined. The reality is that the databases traditional companies are using today to store their data, or your data, wasn't originally designed to support this kind of analysis. A lot of money and IT resources had to be exerted and wasted on getting the data together. Constantly transforming inflexible data from these databases to fit and play well with each other, and setting up the various underlying IT hardware boxes and software to make any analysis even possible. On top of that, searching that data would oftentimes be so slow, highly error-prone, and restrictive. Snowflake saw this opportunity and built a software product from scratch that would solve this exact problem in the form of a managed data warehouse designed for business analysis. Both my Disney and my Roku stock are using Snowflake's Media Data Cloud for their streaming ad business. Snowflake's product really applies to large enterprises. If your company is not dealing with millions of users, terabytes of data, sprawling product mix, multiple sales channels, and a massive customer base, then you don't really need Snowflake or a data warehouse. But when you start operating at a scale where you're dealing with big data, you will really need Snowflake for business performance. The opportunity cost of hiring database experts, infrastructure leads, and specialized developers to build your own internal data warehouse would be more expensive, time-consuming, and painful when you could just buy Snowflake as a service. And when you're a big Fortune 500 billion-dollar enterprise, a couple $1,000,000 to buy Snowflake is just a drop in the ocean with your massive IT budget. As a result, Snowflake's go-to-market strategy is aggressively focused on these large Fortune 500 enterprises. Snow relies on traditional direct sales as their primary channel to aggressively target top-down IT executives and upper management instead of a more organic, common bottoms-up strategy. Rather than trying to win over the low-level data software engineers who are the true end users of Snowflake's products, Snowflake goes after high-level executive decision makers who set budgets and make purchasing decisions. If you are trying to sell to C-level executives at Fortune 500 companies, you need great sales reps with powerful connections to get the foot in the door. You also need technical talent to showcase the product and woo these executives, and even better sales leadership to close the deal. Snowflake features on the highest sales and marketing spend of any public software company to date at 70 to 80% of their overall revenue, meaning each $1 Snowflake makes, they had to spend 70 to 80 cents to make that dollar. Well, this would sound fatal to trigger Warren Buffett's allergy to unprofitable cash-burning early tech companies. The distinction here is that Snowflake's heavy investment in sales and marketing is netting some incredible results. You can throw tons of money hiring the best sales reps in the world, but if the product, its pricing, and messaging don't back it up, you won't be able to close deals consistently. In Snowflake's case, the messaging is clicking, the reps are selling, and most important, all of the product is backing that talk up. In the world of enterprise software, investors typically peg 110% retention as good and 130% as best in class. Snowflake boasts a best in class 160% retention rate, an incredible milestone that beats any public enterprise software company by a significant margin. That means that for every dollar of revenue that Snowflake gets from its customers a year ago, those exact same customers today are now paying $1.60. While retention rate has come down, it's still higher than Palantir. Snowflake could acquire 0 customers, make no new sales, and still be doubling their revenue every 18 months. There is no better sign than retention rate when it comes to evaluating enterprise software. It means that customers are happy, getting value out of the service. Snowflake's NPS, Net Promoter Score, which is a measure of how happy the customers are with your products, it sits at 71. For comparison, Apple's NPS is at 48, Netflix is at 45, Palantir NPS is at 33. Based on customer retention and NPS, it's clear that Snowstock is technically backed with a strong standalone product that organically keeps customers engaged and happy enough to keep spending more. The reality is to appreciate just how difficult it is to do what Snowflake has accomplished and how the business very much represents. Sales and engineering. It's a tough balancing act to get right, but Snowflake is the rare tech startup got it right, having a powerful standalone product, a deep moat in a fast-growing emerging market, an aggressive go-to-market strategy that is winning over Fortune 500 company executives, an incredible customer retention rate that outperforms all other public software companies. You can see that Snowflake is slowly becoming a monopoly in the making. This is why Warren Buffett is owning the Snow stock. I will start buying my shares at $140. Are you buying? Let me know in the comments section below.